Hello investors, welcome to Simpli Stocks. Although the macro environment is currently very volatile and there is a lot of uncertainty, but overall the results of our watchlist stocks have been good only. Right now, my advice to you will be that you should keep investing in a staggered manner at least. If you wait for tensions to reduce or completely end, then you may not get the valuations or prices that are available today. And these valuations are there because of the high uncertainty in the market. So continuing in the same direction, today I have brought 12 small cap businesses for you that have reported strong Q4 March quarter results so far. So without wasting any time, let's quickly get started. The first business on our list is Cemindia Projects. Earlier, Cemindia's name used to be ITD Cementation. Last year, it was acquired by the Adani Group. The reason Adani acquired Cemindia was because of its expertise in maritime structures and metro rail projects. The maritime skill set is directly useful for Adani Ports and SEZ. That is one part. And before Cemindia, the Adani Group did not have presence in metro development and tunneling works. They used to handle other EPC projects like road and highways to commercial projects and airports even. But with the acquisition of Cemindia, metro and tunneling works have also been unlocked for Adani. Now, as investors, the point to note for us is that Cemindia focuses on complex projects which have a better margin profile. Additionally, since they came under the Adani Group, they are benefiting from both fresh order wins as well as subcontracting work from the group itself. Like in these months of January to March alone, they have received a road project for an 82-kilometer 4-lane expressway from Mokama to Munger in Bihar, and the contract value for this is approx 3,100 crore rupees. Apart from this, they also received an order worth approx 1,600 crore rupees for the construction of a container terminal at Adani's main Mundra port. Similarly, they were awarded Pune metro contract before that. So Q4 we can say was a big quarter for them as they received orders worth approx 5,150 crore rupees in this single quarter alone. And with all these order wins, the company's total order book has now reached more than 24,500 CR. And although it is not written here, but because of all these order wins, their order book itself has grown by 40% year on year. Here you will see that 33% of the order backlog is from the maritime sector and 23% is from the urban infrastructure, metro and airports, in which most of the orders are specifically for metro. And here if I give you some perspective, in maritime space, Cemindia is involved in the development of such jetties, container terminals and breakwaters. As for metro rail, they have expertise in tunneling and underground stations. Like they have executed projects for nearly everyone from Chennai to Kolkata and even Mumbai Metro. Now let us look at their results. Then we will talk about the management outlook for the future. So in Q4, you will see here their revenue grew by 17% compared to the last year. They had some pending payment claims that got cleared, which led to this margin expansion which you are seeing here. And that is why the margins were so good. As a result, both net profit margin and also net profit both have doubled compared to the last year. Now going forward, yes, margins will normalize again. But the main highlight for us from this Q4 performance is the order inflows, or basically the major orders they have won recently. And I have already discussed this with you. Now let us quickly talk about what all the management said in the con call. That is important. So for this year, the management has given a target of 25% revenue growth, and they have plenty of orders to achieve that, we know. They have given EBITDA margin guidance of 10.5% for FY27. In FY26, the company got the benefit of claims being cleared, which is why full year EBITDA margin stood at 11.9%. So yes, as I told you, margins are going to normalize. So it is possible that both revenue and net profit grow at 25% rate only in FY27. And we will not get to see operating leverage or margin expansion playing out at least this year. But still at current PE of 25, this is good growth. This is a good valuation you are getting. And as I emphasized, Cemindia is not your regular EPC player. They are involved in, or let us say they have capabilities to to execute complex projects. And in the near future, they are optimistic about more order wins, like they are optimistic about phase 2 of Navi Mumbai airport, which the second airport of Bombay, which recently became operational. So its total value will be around 70,000 crore rupees, and out of which work worth 25 to 30,000 crore can flow to the Adani Group itself, and here Cemindia can get orders worth 10,000 crore rupees from that. So that will be a big trigger for future growth. Additionally, they have given a capex guidance of 350 to 400 crore rupees for this year. They are bullish on the highway tunneling and metro segments, and going forward we should expect order wins from this segment. And for this, they have total tunnel boring machines, or TBMs, of around 10, and all of them are currently booked right now for the existing orders. So they will most likely utilize this capex for acquiring more TBMs. So Cemindia is a good business that you can look into. After Cemindia Projects, let us look at wire and cable stock RR Kabel. And ironically, RR has cable only in its name. In reality, most of their sales, about 73% right now, come from wires. Cables only contribute 27% to sales. However, this product mix is changing. RR is currently doing a capex of about 1200 crore rupees to increase its cable manufacturing capacity. And by the end of this year, their target is to increase the share of cables in the business to 31%. Now, there is, no point in going too deep in the business model. We all know what wires and cables are. So let us directly move to their results and future outlook. But yes, don't worry, if anything important comes up, I will keep highlighting all the important points for you. Now, here you will see in this slide that their sales in Q4 grew by 34% compared to the last year. A significant contribution to this came from the rally in copper prices. As you would know, wires mainly have copper. And if I talk only in terms of volume, there is about 5 to 6% volume growth in wires, which is their main segment. And in cables, it was about 17 to 19%. Nevertheless, these are good numbers, because what happened was, until now, the sector was seeing heavy stocking activity, because copper prices were going up very fast. So dealers and distributors were buying wires in bulk. Therefore, till now, the wire business drove growth. And now the cable business is driving growth by growing in high teens. And if you look below, you will see here that EBITDA grew by 34.6%, and EBITDA margin improved very slightly. And as a result, net profit grew 30% compared to last year. Now, let me bring your attention to the right side of the table. Here you will get an idea of the opportunity in RR. So here you will see that in FY25, the EBITDA margin was 6.4%, which has increased to 8.1%. And this is because of cables, because cables have better margins. For example, if I give you some perspective, Polycab's EBITDA margin this year was 14%. Plus, RR is also benefiting from operating leverage. So management has said that by FY27 end, they will improve this EBITDA margin from 8% to 10.5%. And this is the major short-term trigger for RR cable, which will lead to PAT growth, or good PAT growth. Now, going forward, if copper remains at the current rate for the rest of this year, then they can do roughly 30% sales growth. In this, the contribution from volume growth will be about 16 to 18%, and the growth driver will be your, as I highlighted, cable division. And if by chance copper rallies further, then growth can even go or beyond 35%, or who knows, even higher. But I'll say you should not get too impressed by whatever top line growth alone is. The main thing we need to track is the volume growth. And furthermore, if this 2.4% expansion in EBITDA margin gets fully passed on to the net profit margin, we can expect a full year net profit of about 875 to 900 CR for RR. And based on this estimated net profit, the estimated forward PE for this year comes out to 25, which is again a very good valuation for a wire and cable business, which is growing at such a healthy pace. Although one gap or risk I personally see in RR, which can actually be an opportunity also to time this business at a better price, is that their Q1 results or April to June results might be slightly weak. And the reason for this is that about 30% of their sales come from exports, in which the Middle East has 40% share. There was not much impact of West Asia crisis in the March quarter because the war only started at the end of February. So there was only some 30 days business loss, but the full impact will come in Q1. So if you are interested in RR, I will say instead of going all in at once, you can consider this risk and accordingly you can time your entry. Now, humble request just before moving forward, if you are liking this video so far, do give me a thumbs up. Also, you can subscribe to our channel Simpli Stocks, where we bring multiple such videos every week. Honestly, your likes and subscribes are our only motivation so that we keep bringing such high quality research to you for free. So do like this video and yes, also subscribe to our channel. Let us get back to our discussion now. Our third business for today is Skipper. Skipper operates in the power transmission and distribution sector, and the company is involved in installation of transmission towers and transmission lines. They also have their own manufacturing capacity of 375,000 metric tons for transmission towers. So basically, Skipper is an integrated EPC power transmission player. They also have a PVC pipes and fittings business, but that is not a major segment, so we will not discuss it. Now, the results themselves were good. Like here, you will see sales grew by 29% compared to the last year. It is not mentioned here, but their main engineering or power transmission segment that delivered 33% top line growth. Apart from that, operating leverage also helped, because of which margins expanded slightly. Finance costs also reduced, and overall net profit growth came in at 70%. So the headline numbers were really good, and even I was happy after seeing these numbers. But they have reduced their growth guidance. That is the problem with Skipper right now. They had reduced their growth guidance for FY26 as well. When the year started, they used to talk about 25% sales growth. Then they made it 20%. And now the management is giving even lower growth estimate for this year or FY27, as they say their target will be to grow sales or revenue by only 15% and profit growth will be 30%. So until this growth rate goes back above 20-25%, Skipper is no longer an attractive bet or business for us. That is my opinion. And the reason I started tracking Transrail and Skipper was because a lot of capex is being done to expand and upgrade the power transmission network across India, across the whole world, because the power demand is rising anyway. Plus, data centers are also coming up, which are driving capex because their electricity consumption is very high. Plus, green energy also has a role in all this, because you would know that solar plants or wind power plants are set up outside the city where there is empty land, but the consumption of power happens in the cities. So as usual, you would need transmission lines to evacuate power. And already solar power plants are getting delayed across the country because there is not much enough transmission capacity out there. So these were the triggers that have kept this sector in focus. But on ground, if you see, the progress is not happening at that pace. For the past 2 years, a lot of work got stuck due to delays in right-of-way and forest clearances. Right-of-way is basically when the government takes land from citizens for highway construction or installation of transmission lines. Apart from this, there is also shortage of equipments such as transformers, etc. Therefore, this entire year of yours, FY27, will go dry for transmission theme, and many projects from last year are being rolled over to this year. And besides this, Skipper's export segment that also got suffered, as Middle East was a major market for them, and that is entirely impacted due to the ongoing war. And because of the war also, freight costs that have also, or they have also increased. So customers in other markets like say Africa are delaying deliveries in the hope that freight costs normalize or reduce a little bit, so then they will take deliveries. So overall, the entire export segment that has also taken a hit. Now, to counter this, although the company is diversifying into other geographies, for example, they have received a major order in North America, but that all will not be enough. Therefore, I can say that for Skipper, both right now the domestic as well as exports market will remain weak this year, and in the current scenario, it would be best to switch from Skipper to other businesses for at least for now till the situation improves. Yes, one more thing. in their con call, there was a issue around receivables that was also highlighted, and their receivables, if you see, they have doubled compared to the last year. So on that, the management has given clarity that about some 260 crore rupees came late on April 1st or 2nd due to a technical error, and therefore they could not record it on the books for Q4. And another reason is that the domestic revenue grew more in Q4. As domestic revenue has GST, it looks inflated, plus the payment cycles for domestic sales or revenues or orders, they also run late. Now, although management has said that out of 1485 crore rupees, by which the amount debtors had increased, about 600-700 crore rupees or approx money has come in April. But when their Q1 con call happens, we will have to closely track these trade receivables number. That is going to be important. Now, finally, the fourth business is India Shelter Housing Finance. And just in case if there are any new viewers, let me give a brief overview of this company or the business model. Then I will come straight to the results. So India Shelter is an NBFC and they provide affordable housing loans, meaning home loans of small ticket sizes in the range of about 10 to 15 lakh rupees. And they are mainly present in the tier 2, tier 3 or small cities. And the entire segment of this affordable housing that is currently booming. Now, starting with the headline numbers, disbursements, meaning new loans, grew by 11% year-on-year and 6% quarter-on-quarter. Gross AUM, meaning total loan book, grew by 29%. Their guidance was around 30 to 35% for this year. So this is still within range. Here you will see that India Shelter's AUM or loan book has reached 11,000 crore rupees, and they have a long-term target that till 2030 they are going to increase the loan book size to 30,000 crore rupees. And for that, they will have to grow consistently at about 30% rate from here. Now, since there is so much uncertainty right now, the management has said that at the ground level, although so far there is no stress, but even so, they are lending a bit cautiously. The disbursements growth for Q4 was a bit slow because of this factor only. But keeping the geopolitical tensions in mind, management has given a disbursements growth guidance for 20% for this year. And this target of 20% new loans will result in 27 to 28% AUM growth for this year. But from next year onwards, they will have to speed it up to reach their long-term target, else they will miss that. Now, hopefully, war should end this year. It should not extend further. And as such, this is not, I will say, a bad guidance. This is good. These are good numbers considering all the macro environment. And you will see that management of actually all the companies right now are maintaining conservative tone. So this is not surprising. Now, asset quality numbers are largely stable. In the previous quarter, a bit of stress had emerged or started increasing in the stage 3 assets and 30 plus DPD bucket, but that has come under control, because what happens is as soon as any loan enters the stage 3, the SARFAESI Act starts to apply there. So that automatically helps in cleaning up the book. And apart from this, you will see here that cost of funds and yield, meaning at what rate India Shelter is raising money from the market, and also at what rate it is giving loans forward. So both these figures or rates are stable. That is good. The yield is 6.6%, but management's yield guidance for this year is slightly lower at 6%. Besides, their goal will be to open approximately 45 branches. Now, lastly, looking at the P&L statement, you will see here the interest income increased by 24% compared to the last year. The company is getting the benefit of operating leverage and will continue to receive it going forward as well. But this quarter, yes, they had to make some extra provisions. Therefore, your credit cost has increased. So there is slightly dull growth of 27% in the net profit. But overall, again, in this environment, these are very good numbers. And what I like in their results is that their BT out ratio that has come down below 4%, whereas you will see that many other housing finance lenders are struggling with the problem of BT out right now. And here, let me explain actually what BT out is. So an NBFC's cost of borrowing is higher than a bank's. As a result, to maintain margins, NBFC also gives loans at a slightly higher interest rate. Now, many times what happens is that as customer gets, let's say, aware, or his profile or her profile becomes decent enough, they go to a bank and they get a new loan at a lower rate and they get their loan transferred. But India Shelter's engagement with their customers is very good and they are maintaining, which is helping them to keep this BT out ratio in check. BT out basically means that you are losing your customer to banks or any other NBFC. So overall, these are good numbers, nothing to worry about. Yes, a lot of conversation in the con call was also around the fact that they have to keep the share of their housing loans higher than their loan against property. Loan against property are those loans which people take by mortgaging their land or house. Because else what happens is that definition of a housing finance lender that will not get applied to India Shelter. But that is not a big issue. They are managing it quite well and it is not a big deal that I need to go into depth to explain it to you. So no need to worry there as well. So India Shelter's numbers are good. Everything is good here. And the valuation is also quite good right now. So you can look into this. Now, moving forward, so far I have covered 4 stocks for you. The remaining 8 businesses are Tips Music, DCB Bank, SBFC Finance, Bajaj Consumer, Aurum PropTech, Websol, Capri Global, and also Fedfina. I have covered them for you separately in 2 other videos. I will put their link or put the link of those videos for you in the description below, and make sure to watch both of these videos. And whatever doubts or queries you have, feel free to ask me in the comments. And yes, before I end, as a gentle reminder, if you did not like the video earlier, please hit the like button now. And while you are at it, please also subscribe to Simpli Stocks, because if you support us by liking our videos and subscribing to this channel, I will be much more motivated to bring such in-depth research and good analysis for you every week. So with this, I will see you in the next video. Happy investing.